It's now time to check your money with America's Money Maven, Vicki Brackens. Vicki Brackens is the president of Brackens Financial Solutions Network, LLC, and the registered representative of LPL Financial, member SIPC. Vicki, let's get busy. What we got going on today?
Well, it's a new year, George, and we've got lots of things that we need to cover. But as you know, I said that I was going to spend a lot of time, this year in looking at two things, and we set up some goalposts, and that being education and execution. So at the top of this year, I think it makes a lot of sense for us to really look at some of the education areas around your investment planning. I should say this at this point, though, please understand this is not specific investment advice for anyone who may be listening, but a general topic. Your particular investment advice should come from your individual practitioner or your individual representative who's working with you, who knows your situation. Did you know, George, when I began my career back in 1987, what the S&P 500 value was?
Oh, that's a good question. When you start, all right, so let's start with what is the S&P today, so I can have perspective.
Let's go back. I want to put these goalposts in.
All right.
In 1987, when I started, it was 586.29.
All right.
October 1 of 87.
All right.
Day, meaning on the a couple of days ago when we closed out the market, it was 3694.5, 3,694.5. Now I know that number in comparison to what you normally see, which is the Dow Jones, sounds small, but I chose the S&P 500 because the S&P 500 as an index, and I want everyone to go up and look up an index on
Investopedia.com.
Wikipedia.com, but as a measuring tool, measures the 500 largest corporations in the country. So it gives us a broader scope than looking at the Dow Jones, which is actually only 30. 3,694.5 versus 586.29. What does that tell me? The market, the economy, the market has grown. The economy has grown consistently year after year, year after year, year after year. Also, did you know that when I started my career, shortly afterwards, October 19th, we had the first, what we would call in modern history, major downturn, which was called Black Friday. So we've come through, I don't know how many ups and downs, some of the major ones being Black Friday and then the dot-com bubble and then the Great Recession. And then most recently, what happened last March and April, when we had the pandemic crash is what I will call it. We've had major indices drop dramatically, have had quite often anywhere from 10 to 20 to 30, in some cases 50% downturns. But in relation to end to end, from beginning to now, the market has continued to climb, to climb, to climb. Why am I pointing this out? There are two things that we have to contend with when we are investors. First is volatility. Second is longevity in the market. What I mean by longevity is that you would have experienced that growth if you had taken that entire time period and just continued to consistently invest in the market. You would have realized that S&P 500 growth. But if you try to time it, deciding, okay, this is the perfect time and this is not the perfect, if you try to trade it, your likelihood of having the same success drops. Now, there are some people who are experts at this, as far as timing the market and understanding what all of the charts and graphs mean and all those types of things. But for the most part, as Jack Vogel, which is one of the most famous investors, or Warren Buffett, it's the time in the market, not the timing of the market that produces the greatest results. I'm bringing this point forward because the attitudes that I have heard lately about how to be a successful investor.
What have you heard?
I have heard things like, well, you have to wait. You can jump in and jump out based on this kind of formula or this kind of action within the market. If you have the liquidity to actually execute those strategies properly, then they may work for you. But if you are not properly prepared, meaning have the liquidity to take the losses with the gains and to account for the taxes and the trading costs and have the expertise as far as experience to do those types of or follow those types of recommendations, more than likely you are going to get a worse result than if you are consistently investing in the market around a strategic asset allocation that matches your investment risk tolerance. Okay, big sentence. Do your investing based on a consistent amount of capital going into your account, like your 401ks.
Sure.
You are using dollar cost averaging in that process. Set up your investment strategy so that they are built for the long term. Make sure you get prepared to become an investor. How do you get prepared to become an investor? Number one, first thing, make sure you have the liquidity so that you can stay in the market versus looking at your investments as a way for you to go into pull out for expenses and things that happen and so forth. You don't want to actually use that as an operational account. That is a long-term account in order to reap the benefits of being an investor. Here's the thing that I've seen recently also. Belief that an event is a trend. Because it's not, okay? You know, I showed you here that we had 586 is the beginning number and 3694 is the ending number. A lot of stuff happened in between and we had all kinds of recoveries. You can go into Investopedia and read about this more. K recoveries and U recoveries and V recoveries and L recoveries. And that's basically just describing how the market shifted during those times.
But Vicki, let me say this. So I know you're saying something, but what I just want to point out that a lot of people looked at the pandemic, and I know you're not giving advice. I'm just telling you what people have said. They looked at this pandemic as a way to get in because of the valuations and things of that nature. And what I'm hearing you say you're really talking about a strategy like that is what I'm hearing you say.
Well, not exactly.
Not exactly. Okay.
I've heard that too.
Yeah.
And that bothers me somewhat.
Not
because there was not an opportunity there, but because the way the opportunity was executed and described may lead a lot of people to lose money that they are not prepared to lose. We had now in what's called a V recovery. Sweep down. Remember we started talking about it just when the pandemic started. I had a segment on what's called black swan events, quick dives of things that happen that out of the blue that are not systemic to the investment market. So we had what's called a V recovery, rapid down, rapid up. That is one way a recovery can take place, but you can also have several other different actions as far as recoveries are concerned. And if you are not, for example, an L, think about an L, down and out. Down and out was basically what happened during the Great Recession. It took 10 years to actually get back from top to bottom back up for that to really take place. So to believe that the recovery action is going to be the same as it was 6 months ago every time can lead individuals who are not prepared for the long haul to lose money because they are using vital day-to-day monies in order to enter the market. That's why I'm concerned about conversations like that I've heard, because it can become very reckless for a lot of individuals in their own personal finances. So, George, here's the bottom line. If you are going to become an investor, understand first of all that investing is not saving. It requires long-term strategy. understand that you are going to have some level of volatility throughout the process, that in order to really reap the benefits, you need to be prepared for the long haul. Also understand that as an investor, you need to study and research what you are investing in to be sure that you understand it versus just following. A lot of people are off the cliff at times, okay, that are making suggestions for you that may not meet what you need to have done in your own personal finances. But most of all, here's the most important information. October 1, 1987, 586.29. January 5th, 2021, 3,694.5. Get involved. Sitting on the sidelines, even with all the things that I told you need to be done, and you must follow those steps, but sitting on the sidelines does mean that you have missed an opportunity long-term to take cash, to take resource and leverage it through the growth of companies, through the growth of the market long-term. So at this point in time, I'll say, George, I think, I haven't filled the plate. The plate is like heaping over. We're going to come back and dissect this more and more. I truly encourage everyone that if you have questions, reach out to me at info@brackensfsn.com. That's brackensfsn.com, and to subscribe to us on YouTube. And if you have a question also, you can give us a call at 315-930-4499.
And one more thing, Vicki, that you have to say as you're the CNY Jazz.
Oh, yes. February 28th, the CNY Jazz Black History Month Cabaret, which is now our 13th year with us, that we've had this partnership with Brackens Financial Solutions Network. Go online at cnyjazz.org, get your tickets. We're doing a special virtual event this year that is going to be closed to only ticket holders. So you can't just, you got to get your tickets. So go ahead and get your tickets, and I look forward to seeing you, and we'll give you more details each week. So now, George, I will say, plate is full.
All right, that's Vicki Brackens. Vicki Brackens is the president of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. Thank you, Vicki.
Thanks a lot, George.